As financial institutions continue to declare their 2024 half-year earnings, two key trends emerge. One is a notable reduction in loan disbursements to the private sector, coupled with increasing non-performing loan ratios. The second is the significant contribution of regional subsidiaries to banks' earnings. So what macroeconomics are at play in the Kenyan financial sector? Jimmy Mbogo spoke to analysts to get further understanding of Kenya's financial sector.
Data from the Central Bank of Kenya shows that credit to the private sector as a percentage of total credit issued has dropped to 6.6% as of April 2024. This representing a near-half drop compared to April 2023, where credit to the private sector stood at 13.2%. But just what is demotivating banks from issuing credit to Kenyans? According to the Central Bank Governor Kamau Thuge, the decline has been occasioned by the appreciation of the exchange rate.
In this year, you can see a significant decline in credit to the private sector from 13.8 to about 4%. Again, most of that reflects the appreciation of the exchange rate, and when we correct for the valuation effects, we still see a decline in credit to the private sector, but it is not a sharp decline.
Look at it this way. There is a loan that is given when the dollar was trading at 160, for instance. Now the dollar has moved down to 127, 128. Now, in terms of the shilling equivalent of that loan, it has actually contracted, so to say. So it's from a pricing perspective.
However, according to Kenya Bankers Association, the decline is based on market conditions, particularly monetary tightening, which may signal the market to increase their rates, which in turn deters borrowers from seeking credit. Sentiments echoed by Standard Investment Bank analyst Stella Swakei, who attributed the decline in credit to private sector to the prevailing macroeconomic conditions that have constrained consumer spending.
Then you look at the subdued macroeconomic environment and you see that we've come from crisis to crisis. We started with the issue of the floods back in March to May, and then just after that we jumped right into demonstrations regarding the rejection of the Finance Bill 2024. So when you get this combination of a subdued macroeconomic environment and a very expensive credit, then this you get to see is the perfect.
So because of high cost of living that we saw last year, and of course now interest rates moving up, so loan repayments also become a strain for many of the borrowers.
It is also imagined that banks in Kenya are facing numerous challenges, forcing lenders with regional presence to now turn to their subsidiaries to compensate for the shortfalls in Kenya.
I mean, the inflation in Kenya is not necessarily being reflected in the region. So the policy measures being taken in Kenya may constrain business locally, but that's not necessarily binding for markets outside Kenya.
Crowding out has been so significant in the past few months. Yeah. So government securities have become very appealing and attractive to banks. And
proposed reduction in domestic borrowing should provide for lowered interest rates on treasury bills.
Jimmy Mbogo, Citizen TV, Nairobi.